Hey guys, it's Christian, your Vancouver Realtor. And for this video, I want to show you how to calculate your investment property return. I meet a lot of clients and they want to buy a second property, an income property, and they don't know what they don't know. They don't know all the expenses involved. And to make it simple, clear, and easy to understand, I'm going to do that for you, and I'm going to walk you through the process. And I think you'll find right at the end of that holding period that it's well worth it, but you got to know the numbers. So let's do that first. So let's jump into it. And the site that I recommend is calculator.net. And when you Google it, this will show up, and just click into calculator.net. There's hundreds of calculators here. We, of course, are looking for a rental property calculator, and we're going to find that in the financials and under real estate, and find rental property calculator. Click on that, and we're going to have this rental property calculator show up. Now, what I like about it is it's simple, it's easy, it's nicely laid out. And look how this works, right? So you get the purchase price, you just input that. Of course, you'll probably be taking a loan, so you would click yes here. Your down payment, if you're buying in Canada anyway, and and it's your second property, it's an investment, you're always going to have a minimum 20% required, so that's easy to fill out. Of course, you can increase that if you want. Your interest rate is another variable on the purchase. And at present, the interest rates are more like 2.4, 2.5%, at least up here. The loan term is generally 25 or 30 years. Most people are going to go for a 30-year term to reduce the monthly payments. Closing costs. So that's going to depend on the purchase price. I'll show you an example in a moment. Needs, repairs. Well, if you're buying something newer, you're going to have no. Reoccurring operating expenses. What I like about this calculator here is you get not only property tax, insurance, the HOA here is the condo or strata fee, but it also includes the annual increase. As we know, those things all go up over time, and this calculator includes the actual variables, that category, so you can increase that by 1, 2, 3% or whatever. On the top right hand, we have monthly income, and normally you're going to be able to, depending on where you live, you can increase rent by 2, 3, 4%. Really depends. Some places down south have no caps on how much you can increase the rent every year. Here in Canada and BC we do, and it's usually about 2%, so we're going to leave it there. Other income, I mean, unless you're renting out the driveway, I'd leave this at nil. In BC, in the lower mainland, it is so easy to rent out, so we're going to leave that at 0. I mean, it is almost, you just don't really need to worry about vacancy rent right now. If you are managing it, then that's 0, but if you're going to hire a company, you might be spending about 7%, okay? For your first property, I always recommend you let somebody else handle it. You do it yourself, actually, because it's not that hard. Selling. When you're selling, you can see, do you know the sale price? Well, you're not going to know the sale price if your holding period is, let's say, 20 years, like in this example. But we can guesstimate at value appreciation. I'm going to say it's about 5%. I think that's being conservative enough, but about 4 or 5%. Let's go with 5%. Cost to sell is a little bit lower than that, so we're going to put that in there, and we've got some numbers to work with. Now, of course, purchase price. Let me show you an example of a property I saw yesterday with clients. So we were looking at a house in Langley. This is the house. Sellers live upstairs. They've done some nice little touch-ups over here. Okay, so that looks nice. Nice new kitchen, new backsplash, cabinets, and all of that. And so that's great. So let's use the numbers from this property and plug them into our rental calculator. So let's go ahead and do that. So they're asking 1.199. What we're going to do is we are going to change that to 1.2 for easy math. Okay, so we've got 1.2 million. Do we need a loan? Yes, it's going to be 20%. So that's going to be about $240,000 has to come from your pocket on this property. And then we have about a 30-year loan at about a 2.4% interest rate. Closing costs, let's factor that in. $1.2 million property. The biggest closing expense here is your property transfer tax. The property transfer tax to the government of BC is going to be $22,000 on that amount. Of course, you're also going to have an inspection. That's going to be about $500. And finally, you're going to have your lawyer legal fees, and that's about $1,200. So we're going to go to $23,700. So that's going to be your total closing costs, okay? And does it need repairs? This house does not need repairs. If it did need repairs, you would put yes, and then estimate those. In value, I suggest you don't use this number and you don't look at this value after repairs unless you're a flipper. Okay, so you're just gonna put no. All right, property tax. Let's take a look. This home is at $4,091 a year, so we're gonna put $4,092 for the property tax. Okay, property tax is probably going to go up 2 to 3%. So let's just say 2.5% on an annual basis. Total insurance, I think it's going to be a little bit higher than that. I'm going to say it's going to be about $100 a month. Likewise, I think insurance is going to increase by about 2.5% per year. This is a house, of course, so there's not going to be a maintenance fee. Or HOA means is the American term for a strata or condo fee. So we're not going to need that. So we're going to just put that down to 0. Maintenance. What type of maintenance would you have? You know, once every 20 years, yeah, you're going to have to likely replace the roof. I'm going to put this number for 0. We're going to subtract that at the end, and I'll show you when. Other costs, well, once a year, let's say something breaks or you got to call in the plumber because the sink is backed up. So let's just say $250 once a year. We're not going to add inflation or an increase for that. Let's jump to the top right-hand column. This house here, I learned the basement is rented out. It's a 2-bedroom, 1-bath basement. And they're collecting $1,800 a month in rent, which is pretty good. And that would indicate that you could get, at the very least, the same amount of rent for the top floor. So I'm going to say you're going to get about $2,000 for 3 bedrooms and 2 bathrooms upstairs. So what we're going to do is let's go back to that rental calculator where we are now. And we're going to say, so the downstairs is $1,800 today. We're going to add $2,000. That's going to bring us to $3,800. In BC, you can increase the rent by the rate of inflation. So we're going to keep it at 2%. Other income, there is no other income. You could rent out your driveway. I've seen owners do that, and so you get $150 from somebody else, but it's uncommon. So let's just leave it at 0. Vacancy, not too much to worry about in terms of vacancies in Vancouver. There's always a lot more tenants than there is homes. So we're going to leave that at 0. And management fee is going to be 0 because you're going to try doing it on your own. Now, and when we sell it, so we don't know when we're going to sell it. Let's say we're going to wait 20 years. That's how long we'll hold. We'll give about 5% per year. And then the fee to sell, buyer's agent, seller's agents, it could probably be about 3%. So let's go ahead and calculate. And here we go. Here's our result. And for the result, what I want to do is focus your attention on really 2 numbers that are most important. And here's this first one, and that is your first year income and expense. And it shows your monthly and your annual breakdown. And you can see this. Negative $400 a month in cash flow. Folks, that's typical in the Lower Mainland. That a lot of these owner investors, when they're buying property, whether it's condos, townhomes, or even houses, they are subsidizing it at $300-400 a month. I do see this a lot in the business. Now, why would you do that? right? Because you want to make money in real estate and investments. Well, when you look at result for the 20 years invested, you'll find, look at this, total profit when sold, 2.4 or $2.5 million. Wow, so that is pretty damn good. And so, well, why is that happening? So a couple of things are happening here that we need to take a look at if we just break it down over time. You are making monthly mortgage payments, and here they've given us the yearly amount, and just shy of $45,000 for 20 straight years. And then what happens is you've paid off most of the mortgage that you owe. And so you can see if you go to the right-hand column, after 20 years, your equity has ballooned to almost $2.8 million, because two things have happened. One, you've paid off that mortgage, but secondarily, the value of this home has gone up over 20 years, right? It's more than doubled in its value. So that is what's happening here. So if you were to sell it, you can see at the top here it says, if sold at year end, cash to receive. You can see after a 20-year holding period, that's an incredible amount of money. And just so you can review again here, this is what we're starting with, right? It's a $1.2 million purchase with the townhouse now collecting $3,800 a month in rent. Now, if you really like the tenants, I'd suggest maybe just keeping the rent the same. You don't have to increase it. You could just keep it at nil. After 3 or 4 years, most tenants will move out, and you can then increase the rent to market. So after 3 or 4 years, the market rent might be $4,400, for example. But let's keep it at $38 for this example. Okay. But that's basically what I wanted to show you, is that that is a pretty good amount of that's a great amount of money, and it'd be great to earn that, wouldn't it? So a few other things. I want to stay away from internal rate of return, because these numbers can get a little bit too technical, or cap rates, which is used more in commercial real estate. Cash on cash here is just referring, the reason why this is so high is it's referring to how much of your own money you put in. Remember that down payment at the bottom here? It says 20%. So that's 20% of this number. Well, that's $240,000. And so if you're getting back to almost $2.5 million, obviously that's what this cash on cash return is focusing on. But yeah, you would say on the negative, the first few years here, looks like the first 6 years in this example, you are subsidizing the property, right? And so that's, it'd be nice to have a positive cash flow right out of the gate, but you don't, and you just don't in the Lower Mainland. And I think the reason why a lot of people will do it is because they'll just say, they'll think short-term pain, long-term gain, and that's kind of the motto for a lot of investors, right? Okay, I think we've probably covered enough for the rental property investment bit. Now, one other thing you could do is, if you wanted to compare, so we took this $240,000 that is your down payment here. What would happen if you just, let's say you put that into an investment for 20 years? And I think this is just an investment calculator. So you take $240,000, and let's say, well, you're not going to make any annual contributions, and let's say it's going up 7% per year. What would happen? What would your number come out to? Not bad, right? I mean, even there, you're coming out to $900,000 if you have your money in investments. And so anyway, I hope that helps. It kind of compares the two investments. Definitely, obviously, coming out with a lot more here, 2.5 million versus 900,000. But both of them are good. I'll take the 2.5. Okay, guys, if you've got any questions, comments, feel free to leave those below.